My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do it, my friends. I'm just trying to save you some money. My job is not just to entertain, but to put this in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. What makes a good investor? It helps to be smart, helps to be hardworking, helps to be disciplined. Above all, though, you've got to be emotionally stable. Now, I know that sounds, coming from me of all people, is strange, but it's what I know you must be, and I know it better than anyone. You can't make good investment decisions when you're flustered or angry or, worst of all, sullen and gloomy.
The House of Pain.
If not saturnine. Unfortunately, this market's enough to make anyone sullen and gloomy, including on a relatively sedate day like today. Dow lost 232 points. S&P declined 0.30%, but the mighty Nasdaq only dipped 0.10%. Tonight, I want to articulate what makes this moment so darn aggravating, so absurdly frustrating. Because if you understand why it's happening, you can prevent the market from driving you crazy. First, there are endless rotations in and out of groups that defy any rational explanation. It's like ETF roulette. Where she stops, nobody knows. When trading opened today, stocks were driven by their own fundamentals. If a drug company has good news, it goes higher. If a broker puts out a positive piece on a health insurer, that health insurer rallies. All of this is highly rational, correct? Then out of nowhere, we catch a rotation out of healthcare. Suddenly, everything that was going up is down. Merck and J&J, they just get hammered. United Health gets obliterated. McKesson and Cardinal Health, two standouts, big drug distributors. They are overrun by sellers. Sell. I spent an hour of my life today checking out what's wrong with all of these stocks. And you know what the answer is? Nothing. Zilch. Nada. There's no reason whatsoever, except that the healthcare cohort has been down for the year, and since it's the end of the month, a lot of funds want to unload their losers. Sure enough, the three other sectors that are down today are the ones that are down year to date that got crushed. Energy, utilities, and packaged goods. They all got hit. It's what happens at the end of a month. All these stocks were down purely because they've been down. Well, there you go. That's total circular reasoning. Now, sure, this is the kind of idiotic action that can indeed create buying opportunities, but it's also very dangerous and very dispiriting. Why is this torture happening? Because of the second problem with this market that's driving me nuts. Most of the time, stocks aren't trading anywhere near on their fundamentals. They're trading as macroeconomic pawns. When long-term interest rates go up, the healthcare names get put through the meat grinder. So if you want to buy something like Merck, great company, into artificial end-of-the-month weakness, remember that when rates tick higher, the stock is going to go lower still. When I talk about rates here, I'm really thinking of the yield on the 20-year Treasury, because that's what mortgage rates tend to be priced off of. The 20-year keeps going down in price and up in yield because these long bonds are ridiculously overvalued. The owners of these bonds lose money almost every day because these bonds have meager yields versus short rates. Who wants the 20-year at 4.1% when you can get the 2-year at 4.8%? When long rates get closer to short rates, this move will stop. But in the meantime, it keeps clobbering stocks. Call it collateral damage from the great exodus from long bonds, thought valuable because idiots thought the Fed would be cutting. I mean, literally, they thought they'd be cutting rates, not raising them into the end of the year. And the industry that's most sensitive to the bond market is, of all things, tech. Now, there's a tenuous link here. Tech is full of growth stocks, and their future earnings are worth a lot less comparatively in a world of higher interest rates. But they're being whipped around by 4 or 5 basis point swings. That is just insane. Today, bond yields were higher at the opening, so tech stocks were almost all down. Then we got some weaker economic data, relatively unimportant, but indeed weaker, and bond yields went lower. So tech made a comeback because bonds had a benign day. Tech did too, led by the semiconductors. I find this kind of action repugnant because it has nothing to do with what's really happening in individual companies. Some of that's because of the increasing ETFization of the market. Rates tick higher, so the algorithmic traders sell the tech ETFs, taking everything lower. Then rates tick down, and they do the opposite. No humans involved. These moves confound me because there's really no relation to a company's health on a given day or hour or minute to all this stuff. It doesn't matter, though. As I said on today's home stretch call for Investing Club members a little after 2 p.m., it's totally maddening. While the macro situation does matter to the whole market, it shouldn't be the only thing that matters. That's how often it just feels like that all the time. That's at the heart of the frustration we all feel. It is just driving us crazy. So we have these meaningless rotations driven by irrational macro minute-to-minute repricing and end-of-the-month window dressing, which is what they call it when money managers throw away the stocks they don't want to show. They don't want their clients to see that they were so stupid as to buy healthcare. That's not all. We're also afflicted by a huge cohort of know-nothings. For example, this morning, Target reported what I thought was a very good quarter with inventories clean as a whistle. That's the key metric for me because lean inventories mean they don't need to be promotional when they sell their excess merchandise because they don't have a lot of excess merchandise, which is, of course, the bane of the entire industry. Yet Target initially saw its stock sell off big in pre-market trading, brought down by, I don't know, bozos, chowderheads. It winds its way down about $1, $2, $3, $4, and then works its way back up to about flat. Then I go on air and I explain that the inventories are what matters. They're 3% below where they've been with discretionary goods down 13%. I said that's all you need to know, that they are lean. Boom, the stock finishes up $1, but at one point, after I pointed out the inventory management, the stock rallied 4 points. Workday. All right, I've known this cloud-based enterprise software company since its inception. The relevant metric here is how much financial business they're doing, because that's what they're moving into aggressively. Workday is software for human resources and software for financial planning. They already own that HR world, but what was encouraging this quarter was the growth of the financial portal. It was incredibly strong. Anyone who follows Workday knows that that is what matters. But the stock initially trades down big for some reason that I find hard to fathom. I mentioned the financial strength on air, and the stock vaults 4 points immediately. How is this possible? How could the markets be this dumb? Yes, and it's making me lose my mind, or at least what's left of it. So what makes the stocks start acting more rationally again? All right, well, let's go into it. First, we need more players. More fund managers who are seasoned, more fund managers who know what they are doing and are not just kind of hanging out trying to be closet index funds. Second, we need to realize that most, if not all, the moves on your screen are driven by something other than company news. A lot of it's the macro, extremely short-term market mechanics, or artificial intelligence that, well, lacks intelligence. Third, we got to accept that the initial reaction to earnings is very often wrong. Yes, this is totally exasperating, but you can't let it get to you. You can't let exhaustion or frustration get in your way. The goal right now is simple. You got to outlast the robots that trade off of algorithms. You got to ignore the idiots who haven't done any homework. And you've got to have confidence in yourself and accept the short-term rotations might give you the buying opportunities that you've been waiting for because you have confidence in yourself. The bottom line, don't let this market drive you crazy like it's doing everybody else. Put your emotions to the side and try to make reasonable decisions about individual stocks without letting the irrational action infuriate you. If you can't do that, please go buy an index fund. Otherwise, you will indeed get blown out by this market's indeed lunatic behavior. Shan in Pennsylvania. Shan!
What's up, Jimmy Chill? How you doing?
I'm doing great. How about you?
Jim, I was wondering what your thoughts on PayPal are, at its current price.
I still think PayPal can go lower. I still think the company is decelerating in terms of its growth. If you want to be something in fintech, you have to be in Square. I actually prefer real banks, though, like J.P. Morgan. Could be $1 trillion bank out 12 years. Ray in Florida. Say Ray.
Booyah, Jimmy.
Holy cow, there's a spirit
viewer, first-time caller.
Thank you.
I am looking to buy some stock in what I call household consumable, and I'm really eyeballing Pepsi. Or can you think of a better one?
No, Pepsi's dynamite. I'm not going to ever contradict someone who wants to be in Pepsi. And some people feel it's too loved. I don't think there's such a thing. It's just a really good company. All right, don't let this market drive you crazy like it is everybody else. Put your emotions to the side. Check them at the door. Try to make reasonable decisions about individual stocks. Oh, man, tonight, Dutch Bros chilled after earnings. So are investors getting a buying opportunity in the West Coast coffee chain, notably Oregon? I've got the latest from the CEO. Then Chevron had its investor day earlier, highlighting a host of metrics. I'm learning more about the latest of the oil and gas kingpin with the company's brass, including its buyback. And Enbridge has a 7% yield amid a tough oil and gas backdrop. So is that sustainable, that dividend? Or maybe investors should be concerned. You won't want to miss with this exclusive of mine, because I got to tell you, I think this one's pretty attractive. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.